Good morning and welcome to TOITOI Japan Market Radio, coming to you from Tokyo on March 22, 2026. I'm your host, and this is our daily briefing designed specifically for global investors tracking Japanese equities, foreign exchange, and fixed income. Today we have a slightly unusual setup because the Japanese market was actually closed for a holiday, but there's still plenty happening in the geopolitical sphere that matters enormously for Japan exposure. Let me bring in our portfolio manager to walk us through what global investors need to know.
Thanks for having me. You're absolutely right. While Tokyo was dark today, the developments we're seeing globally have significant implications for how Japan will trade when it reopens. The Japanese market was closed today due to a holiday, so we had no price action in Nikkei 225, TOPIX, or JGB futures domestically. But the geopolitical environment shifted quite dramatically, particularly around energy security and trade policy out of China, and both of those are major drivers for Japanese asset prices.
Let's dive straight into the headlines then. The most immediate risk seems to be coming out of the Middle East. We're seeing reports that the Trump administration has issued a 2-day ultimatum to Iran demanding the reopening of the Strait of Hormuz, and Iran has responded with a warning. For investors holding Japanese equities or yen exposure, why does this matter so acutely?
This is critical for Japan because of its extreme energy import dependency. Japan sources roughly 80% of its crude oil imports from the Middle East, and a very significant portion of that volume transits the Strait of Hormuz. Any blockade or meaningful disruption to that shipping lane would directly threaten Japan's energy security and by extension its manufacturing supply chains. We're talking about automotive, chemicals, utilities, sectors that are energy intensive and already operating on relatively thin margins.
So when markets reopen, what's the likely direction for Japanese equities?
I would expect downward pressure on the Nikkei 225 and TOPIX, particularly if oil prices spike in response to this ultimatum. Energy cost shocks compress margins for manufacturers and dampen consumer spending power. Beyond the direct cost impact, you also have broader risk-off sentiment. Geopolitical uncertainty of this magnitude typically reduces global appetite for risk assets, and Japan's export-heavy equity market is very sensitive to that sentiment shift.
And on the currency side, we often see the yen behave as a safe haven during geopolitical stress. Is that the expected move here?
Exactly. In the near term, I would expect the yen to strengthen against the dollar. Flight to safety flows tend to favor the yen, especially when the risk is tied to energy or broader geopolitical instability. Ironically, that yen strength actually creates a secondary headwind for Japanese exporters because it reduces their competitiveness and translates into weaker earnings when they repatriate foreign revenue. So you get a double hit: higher input costs from oil and a stronger yen hurting export margins.
What about Japanese government bonds? Do JGB yields move in this environment?
JGB yields would likely move lower. Safe haven demand supports Japanese government bonds, and if growth expectations are being revised down because of potential energy cost shocks, that also reduces inflation expectations, which weighs on nominal yields. The Bank of Japan's yield curve control framework is still in place, so we wouldn't expect dramatic volatility, but the direction is clearly toward lower yields and a flatter curve.
Staying with the geopolitical theme, there's also reporting from Bloomberg about a broader shockwave of war rippling through the global economy. How does that intersect with Japan's vulnerabilities?
Japan faces several acute vulnerabilities when global conflict escalates. First, supply chain exposure. Japan's manufacturing base, especially in autos, semiconductors, and electronics, depends heavily on stable global trade and component sourcing. If conflict disrupts trade routes or creates bottlenecks in regions adjacent to conflict zones, Japanese manufacturers feel that very quickly. Second, as we just discussed, energy security is always top of mind. Japan imports roughly 90% of its oil and LNG, so any regional instability that drives energy prices higher is a direct hit to the economy.
And I imagine there's also a regional proximity risk, given Japan's location in the Asia-Pacific.
Absolutely. Escalation affecting Asia-Pacific trade routes or regional stability directly threatens Japan's growth outlook. If you see disruptions to shipping lanes beyond just Hormuz, say, in the South China Sea or near key choke points in Southeast Asia, that compounds the risk. For Japanese equities, the initial direction is clearly downward. Export-heavy sectors like automotive and machinery would be under pressure from both supply chain disruptions and weakening external demand.
And the yen would likely appreciate again in that scenario?
Yes, safe haven flows would typically strengthen the yen during geopolitical stress, which, as I mentioned earlier, creates a further headwind for exporters. It's a challenging environment because the very asset that acts as a hedge, the yen, also hurts the equity side of the portfolio if you're long Japanese stocks.
Shifting to trade policy, we also saw China's premier publicly commit to supporting balanced trade as Chinese exports surge. What's the significance of that for Japan?
This is important because China remains Japan's largest trade partner. Japan is a major supplier of intermediate goods and components to China's manufacturing sector, think machinery, semiconductors, auto components. Any shift in Chinese trade policy, whether it's reducing import demand, implementing retaliatory measures, or increasing domestic substitution, directly affects Japanese exporters. The phrase, balanced trade, could mean several things, and the ambiguity itself creates uncertainty.
What are the scenarios you're watching?
If balanced trade translates into higher Chinese import barriers or a push for domestic sourcing, that's a moderate headwind for Japanese equities, particularly for exporters of machinery and semiconductors. Conversely, if this is just pragmatic positioning, signaling Beijing's willingness to negotiate rather than escalate, then risk-off sentiment could actually ease a bit, and you might see some stabilization. The key is to watch incoming trade data and any follow-up clarification from Chinese officials on what balanced trade means in practice.
How would that play out in FX and yields?
On the FX side, if trade tensions escalate, you'd likely see the yen strengthen modestly on risk-off sentiment. If the rhetoric is interpreted as more pragmatic, the yen might remain steady or even soften slightly. For JGB yields, the direct impact is minimal. Movements would depend more on broader equity market repricing and capital flows rather than China trade policy alone. But if equity markets sell off on fears of Chinese protectionism, you'd see safe haven buying in JGBs, which would push yields lower.
So we have a confluence of risks: Middle East energy security, broader geopolitical spillover effects, and trade policy uncertainty out of China. When Japanese markets reopen, what should global investors be focused on?
The first thing to watch is oil prices. WTI and Brent are the most sensitive indicators of Hormuz supply risk. If we see a sustained spike in crude, that's a clear negative for Japanese exporters and could trigger policy responses like strategic petroleum reserve releases or additional Bank of Japan accommodation. Second, monitor any updates on the Iran-US situation. An actual blockade would be severely negative for Japan. Third, watch for any corporate guidance cuts tied to supply chain disruption or China trade headwinds. Those would give us a clearer picture of how earnings expectations are adjusting.
And from a positioning standpoint, are there any sectors within Japan that might be more resilient?
Defensives like utilities and telecom tend to hold up better in risk-off environments, though utilities have their own sensitivity to energy costs. Domestic-focused names, retail, services, are somewhat insulated from external trade shocks, but they're not immune to the broader growth slowdown that would come from higher energy prices. Honestly, in an environment like this, the yen itself is the main hedge within Japan-focused portfolios.
Let's bring this together for our listeners. We had a holiday in Japan today, but the geopolitical backdrop has shifted in ways that will matter significantly when Tokyo reopens. The main themes are energy security risk from the Strait of Hormuz situation, broader war-related economic disruptions, and trade policy signals out of China. All three create headwinds for Japanese equities, particularly exporters, and safe haven dynamics favor yen strength and lower JGB yields.
That's a good summary. The key takeaway for global investors is that Japan's vulnerabilities are quite specific: energy import dependency, export sector sensitivity, and supply chain exposure. When geopolitical risks rise, those vulnerabilities tend to get repriced quickly. So even though we didn't have price action today, I would expect markets to digest these developments when they reopen, and the bias is clearly toward caution.
If you're a global investor tracking Japan exposure, this is the kind of environment where staying informed on a daily basis really matters. We'll be back tomorrow with another briefing once we have live market data. If you find this useful, please consider subscribing to TOITOI Japan Market Radio. Thanks for joining us today.
Thank you.